Hi, good evening, ladies and gentlemen. This is Manoj Atri, your host for tonight. I am a real estate agent with Remax Hallmark, and I will be joining with our mortgage expert, Faisal Garcia. And let's get a hi from him, and then I'll start with the agenda of the day, and we'll take it from there. Hi, Faisal.
Yes, sir. How are you?
Wonderful. So we are live today. The weather seems to be okay today, and it's going to go crazy again tomorrow. And
Yeah.
uh, that is where the winter is has slightly extended. So that is where we are. But we have some very good two hot topics today to cover. So that is where we are today.
Hello to the audience and yourself as well. I'll be on the mute on the side whenever you need me.
Absolutely. Yeah, the topic is absolutely relevant to your expertise there. So we will be going line by line, and we will need all your expertise tonight.
Amazing. I'm
Okay,
here.
wonderful. So let me get a head start with the agenda of the day today, and we'll take it from there. So, ladies and gentlemen, as usual, this is how I start, and I start with my real estate monologue. And we are covering two topics, and we'll try to remain within our 1 hour time frame, as requested by most of you. And the first one is the biggest one, and I was really surprised to go see this article, and it says the big bank mortgages by HuffPost as the worst deal around. And I mean, they picked up a few very important stuff there, and this was quite an interesting read, and it was a major time saver in case, and money saver in case, if you can ponder on this particular article and work with us on this one. The next one is the one that is again a very hot topic for us, that rent to own homes from $2,500 per month. So we are going to show you the least one that you can get your head around with the properties that are available in the market, and we will go through all the numbers crunching on this one so that it makes some sense there. And we are on live interview with our mortgage expert. We will be going back and forth with him on each and everything whenever this discussion on big bank mortgages is there. And so without further waste of time, let me take you to that particular scenario, and give me a moment here so that I have my article ready there, and I will have the mortgage expert also there. So let me head up to that particular article. So here we are with this particular article. So let me go there. This is by HuffPost by Justin Thouin. An important article there he has covered. The big bank mortgages are comfortable, they're popular, and the worst deal around. So this is really very important that you comprehend what exactly is he wanting to share it out with all of us here. Why do we stay with them? So he's asking us regarding these big bank mortgages, the big six banks, the RBC, TD, Bank of Montreal, Scotia Bank, CIBC, National Bank, and he's asking us, why do we stay with them? Complacency is a big reason. A lack of knowledge is another. So now, even on this particular headlines, let me get the mortgage experts say on this particular headline there. So give me a moment. Let me head over to him. Faisal,
Yes, sir.
How like can you like hear this out? I mean, like someone has literally nailed it.
Huffington is a very credible source to begin with. We all know. Um, and what they're saying, there's lots of truth to it. Um, they are comfortable because you walk to the corner of your street. There's usually a bank that you go to, or a block or two away. You walk in with your documents, you get a mortgage, and because you have your accounts there, it's convenient. You get a decent rate. You don't shop around. It's the convenience that you pay for. Is it the best deal? 9 out of 10 times, no, it's not. And there's other options to achieve. So, yeah, to answer the question, I don't know if I can say the worst deal around, but I can definitely say there are better deals.
You have been both worked in a bank and now you're working on your own.
Yes.
And you are the best person here to answer this particular as an expert there. Like you have dealt with both the scenarios there.
Yes, you're right. So when I compare a bank to a mortgage lender, a traditional mortgage lender versus a bank, the big question mark that I see is interest rate differential, the penalty. In case you break a mortgage, what will be the penalty from a mortgage lender versus what will it be with a bank? Usually, and this is an approximation, the difference between both penalties is about 60% from one to the other. 1/3 is a good number to go with. So if one of them is $100, the other one is $33. So that's one thing that comes to my mind. There's many. I can list one after another.
Absolutely. I mean, from most of the time that I have seen in general is, see, banks have a setup format and they are going to give it to you only on that particular format. Whereas, it is in your interest to shop around and get the lowest mortgage rates. And most of the time, you're not even paying a mortgage broker for getting you the best deal in the market. So he's a professional working for free for you. And why not take his expertise there? Because when you go to a bank, they're just giving the best rate that they have. Whereas in the market, you may have other good rates. And then you have pointed out, in case if you come up with the scenario that you have to break the mortgage, then the differential is, you said 60% difference, which is huge.
Yeah.
And all of these small things. And when we will go through this particular rest of the article, you will see they are saying you're almost paying close to $40,000 extra. Interesting. Read it. Let's head back to the.
I'm excited to see what.
Yes, I mean, this is. I was amazed when it says. The headlines caught me, and I had to read it 2-3 times even to understand. Yes, someone has literally pinpointed the exact problem, and has highlighted this problem. And that is why, I mean, I take this big opportunity to go through this particular whole article, and I'll try to see. And each and every line was very, very interesting there. Whenever one of these major Canadian banks tweak their mortgage rates, it makes headlines. Okay, we saw last month when RBC dropped its 5-year fixed term mortgage rate by 0.15% or 15 basis point to 3.74%. Every major news outlet in Canada picked it up. Okay, so they are saying whenever a big bank does anything, it is a big news. Whereas the other lenders or the lower lenders, they're already doing it every day. But here's the thing, about the bank's posted mortgage rates. They should not matter. The big banks never offer the lowest mortgage rates in the market, and those are the ones you want to pay attention to. He is absolutely highlighting the gist of this particular one, that okay, everyone is reading the headlines. RBC has reduced rates 15 basis point. And this again has to be understood by the audience and by anyone who's trying to come up with mortgages. The big banks never offer the lowest mortgage rates in the market. Let's head up to our expert there. What do you have to say about this? He
You're
has
right.
literally nailed it, I think so.
See, other lenders are already giving a better rate.
Yes.
So it's not really a news by dropping the rate 15 basis points. However, because it is one of the major banks,
it's a news headline.
It's a news headline.
Yes. Okay. Let's go dwell further. Canadians pay attention to the big guys. However, because they are either too comfortable to make a change or simply not aware they are being taken for a ride. Literally, it cannot be pointed out they are being taken for a ride. The banks have a 90% stranglehold on the Canadian mortgage market, and we have been slow to start paying attention to the alternative, often cheaper options out there. Very much has to be understood by person who is wanting to procure a mortgage. You need to shop around. Okay, complacency is a big reason. A lack of knowledge is another. So they have pointed out two major things that are going on. One is complacency, and the second is lack of knowledge. Let's see, there is a whole industry of smaller, more competitive mortgage lenders and brokers who never make headlines. They're often just as established, they have absolute just as reliable, and they're significantly more affordable. Let's get the experts. So now, I mean, in your business, how much, I mean, when someone comes, I mean, do you find the bank rates better, or some other lenders are giving much better rate? And what is the ratio? I mean, how many times do you take them to the bank, and otherwise you can get a better rate outside?
Most times, the mortgage lenders tend to have better rates, most times. And not just that, they have a more fitting product. What I mean by that is, for instance, if someone is buying a condo, it's a young couple, when you discuss with them, their idea is, I'm going to buy this today, few years later, I want to upgrade. Okay? So at that time, when you keep that in mind, you give them a product accordingly.
Okay.
You give them a product that has the lowest interest rate differential possible, because depending on which lender you can go to. Number two, you give them a portable mortgage. And number three, you make sure that a few other things are lined up. Now, when you go to a bank, you don't have those options. It's product one, product two, product three.
Oh, okay. So they and they know they have the business.
Yes, and it's the convenience. It's no different than buying a Coca-Cola at the convenience store versus a superstore. Of course, it's going to be cheaper at the superstore, but you're going to the convenience store because it's convenient.
Wow. Yes, you gave a very nice analogy there. Okay, let's head back to the article again. But you are you finding the article an eye opener here?
You know what? This is the truth. Me being the mortgage broker, I do know this. I've known this for a long time, but it's hard for most clients to know that this exists.
Yes, and it is in their interest.
Yes.
And the best thing is that the article picked up one example, and even with one example, $40,000 difference.
Yeah.
Small example, and let's head back to the article there and see. Okay, so why do we stay with the big bang? Again, two factors he has left. Complacency is a big reason, lack of knowledge is another. In every unhealthy relationship, there comes a time to say enough. And unless you enjoy funding the mega profitable big six, there's no better time to say it than now. Here are two reasons you should ditch your big bank and try out the plethora of small lenders out there. Brokers and small lenders often drop their rates first. It has to be understood very. So if there is a change, they are the first ones to drop their rates. In a nutshell, here's how mortgage rates work. It is very important to understand this. Lenders, whether big banks or small lenders, lend money to home buyers in the form of mortgages. Even big banks have to borrow money at times to ensure they can lend money out to meet the demand. And they always borrow at a lower rate than they lend it out. That's how they make profit. Simple equation, nothing too major. They borrow the funds and then they lend it out to you and they make a profit in between. Now, let's say beginning, and here is an example. Let's comprehend this particular example and then you will be able to realize what exactly is going on in the market. Beginning this past fall, the rates that lenders were borrowing at began to fall. For example, in November 2018, a 5-year Government of Canada bond was costing lenders 2.5% in interest. It is now costing them around 1.75%. That reflects the cost of lending in the bond market, which helps influence fixed rate mortgages. But the big banks are only recently starting to pass these savings to Canadian consumers. So they take their time to reduce their, even if their money has their lending rates have gone down, percentages have gone down, but they take their own time to pass these savings to Canadian consumers. That has to be understood. Smaller lenders and brokers began lowering their mortgage rates ahead of the big banks in January, when they should have. But you did not hear about those rate changes because small lenders don't make headlines. And that is what has to be understood. What do you have to say about this?
Yeah, it is right. It was it started the rate started to fall first week of January, first to second week of January.
And so that means even if November to January, I mean, they're taking their sweet time.
Yeah.
And so,
in fact,
in fact, if their rates rise, your rates rise the next day.
Yes.
But if it falls, it takes them 2-3 months to come back.
Exactly.
And and that is also has to be perceived by consumer, that in case if you're in a variable rate with the bank, they'll take at least 2-3 months more to make more money from you, and then before they pass on that to you.
Absolutely.
Every month it is quite a task. And these things, they look very small. I mean, in the article you will see that the difference looks like $100, but then in the whole year it's $1,200. You could have done something else with it.
And the bigger thing is that $1,200 did not, because if it was gone towards principal, it would be lesser interest the next year.
There you go. So another step that they have been missing it over. Okay, yeah. But I mean, my quick question to you here is, how are you finding this article till now?
I, I'm not sure why it's not made even a bigger headline.
Yes, because I mean, I had made sure I passed that particular information to all my prospects and the audience that I have, and also taking an opportunity to go through this particular one line by line, and so that they understand it is in your interest to shop around. It is your money. It is not the convenience.
Yeah.
It is like you just need to, or if you're working with a real estate agent, he may have a team. You may have your friends. You can ask them. They may have worked with some other mortgage broker or a lender. There are plethora of professionals who can do wonders.
Yeah.
And it is basically in their interest to work to get save more money here. Let's head with the example that's coming ahead. Even if brokers and smaller lenders had lower rates to begin with, okay, so again another line here, they already had the lower rates to begin with. So even at any given opportunity, that is what I'm figuring it out, the smaller lenders already have lower rates than the big banks. Even if we put aside the fact that the big banks were inexcusably late with the recent rate drop, it still does not make sense to stay with them. That's because small lenders and brokers consistently offer mortgage rates that are way better than those posted by the banks. Now, let's get ahead with the example here, and that's the very nice example. He has picked it up, and with the recent scenarios that have gone as a change here. Case in point, RBC's news-making 5-year fixed rate of 3.74% would mean a monthly payment of $2,560 on a $500,000 mortgage, assuming a down payment of at least 20% to avoid CMHC insurance and a 25-year amortization period. So he has put in the format, and he's now going to compare these two rates here. If you took that same buying scenario, $500,000 mortgage, no CMHC insurance, 25-year amortization, and mapped it onto a best currently available 5-year fixed rate available in the market, which happens to be 3.23%, already a 0.51% difference. At the time of publication, you would be looking at monthly payments of $2,426. That's a monthly saving of $134. Might not seem like much, but over the course of the 25-year mortgage, you're looking at saving $40,000 and $200 by ditching your bank. This is the important number. Let's seek these numbers crunching from you. What do you have to say about this? $40,000, just $100 difference.
Yeah.
So it does accumulate.
It does.
And $135 is not a small change.
You're right. It's just the way. It's the convenience. It's really the convenience that clients pay for, and it's the ease of, oh, I know my banker. I've known them for 10 years. I've banked with this bank for 10 years, and I get these clients that have banked with them, their bank for numerous years, and then when it's time for, let's say, switching a property, and switching a property is a big one where I see where bank cannot do typically what a broker can do. Brokers can do a lot more than what bank can do, for sure.
I'll take this opportunity here. I'll not take names here. I had a client, a client who worked in a bank, and his bank won't give him a better rate, which we could get him from outside. And then he went back to them and still they did not match it up. And then, I mean, that is where it is. It is in, I cannot harp more on this particular one. It is your money. It is, it is just a phone call away. Talk to your real estate agent. Talk to anyone in the family and friends. Ask them, I'm trying to buy, and take a second opinion. Like, even if you're trying to do work with a contractor, you generally take 2-3 quotes. Try to do that basic stuff. And it's all free. Whether you're working with a mortgage broker or you're working with a bank, they both were free. Here, you have a professional who's going and checking out 20-25 lenders for you instead of just one that is a cookie cutter for them, and you're just signing all those documents.
Absolutely.
So I mean, I'm taken over by this pinpointed and written step by step, and pointing it out, highlighting it, even if it is 134. Now, this 134 is only for $500,000 property. If it goes to $700,000 or $800,000, it's even close to $200 or $250 per month.
Close to $80,000, maybe more.
Yes. So that is where the and that it's a huge amount. And then you have also pointed it out. If you by chance take a variable, they take their time to come down.
Yeah.
The differential, if you have to break a mortgage, then the difference is huge. And in case if you have some other format, like the mortgage lender can have a better alternative for you. So it is in their interest to go outside and work this out. Let's head back to some of the finishing touches to this particular article. So here is the headline that you should see, but you never will. Canadians are overpaying by staying with their big bank. He has literally nailed each and every wording here. Awesome. I mean, this is an awesome article, which anyone in the mortgages trying to procure a mortgage should do shopping around. But we can all change that. Start by making sure that when you get a mortgage, you are not just walking into the bank and taking the first rate they offer. Shop around and compare. Hop online and see what competitors will offer you. It is in your interest. It is your money. You are going to save. We all compare, and this is also something interesting that he has written. We all compare flights and hotels when we are taking a trip overseas. We should start doing the same for financial products. After all, the money you can save on a vacation pales in comparison to what you can save on a mortgage. The article is really nailed it. He really nailed the big banks and the small lenders.
I like the word he's used, pales.
Pales in comparison. Absolutely.
Yeah.
Absolutely. And I mean, what do you have to say in the end note here when we are done with this article? And now we'll take out the rent-to-own format and we take it to the next explaining of our stuff there.
The summarize, if I was to make, few sentence comment on it, I would say, one, of course, compare, shop around, but don't make sure that you're not hitting your credit every time you shop around.
Very well taken point. And how would you say they should go about it?
Quite often, you go into, let's say you're banking with one bank, you walk over to the next one, or, so on, or you're shopping around. And if they say that we have to do a credit check to give you a best rate, that's not something you should let them do. In fact, do your own credit check and take the document with you.
That is what I was saying to you. Even to the mortgage lender or anyone, go to Equifax, spend around $20, $30. That is what they charge. Print out the whole credit report and score, and tell them, here is my credit report and score. You don't need to pull out anything. Here it is. This is pulled out recently. Come, tell me what you can do. And same thing, I mean, they can share it with the mortgage brokers, because every time there is a hit, the score goes down.
Absolutely. So that's one. When you do a comparison, specifically a bank with a mortgage lender, the penalty is much less with a mortgage lender.
Oh, okay.
Okay. In variable, it's the same. It's 3 months interest. But in fixed rate mortgages, it makes a difference. Number one.
Okay.
Another point I would say is when it comes to when you're looking at two product, a bank versus a monoline, I'm saying mortgage lender. The product itself has a lot of features and benefits that don't necessarily exist with the bank. Then on top of it, the two contracts out there in the market, one of them is called as a collateral contract. Another one is called as a standard contract. Now, standard contract allows you to be a free bird at the end of 5 years. And you can transfer your mortgage to another lender if that lender is not giving you a good rate.
Makes sense.
Okay. Now, for our clients, I'll repeat one more time. Let's say at the end of 5 years, you are with a mortgage lender and it is a standard contract. You are a free bird. You can go to any other mortgage lender that is offering you a better rate. If you are with a bank, by default, their contracts are they are collateral contracts. What that means is to transfer the mortgage to another institution, you are going to a lawyer, and the lawyer has to literally discharge the charge and place a new charge.
So there will be a charge for the lawyer.
Absolutely.
So basically, in the end, you are pointing it out. There are more details to it.
Absolutely.
You have to go through the details, not only the rate, but there has to be there are more things in the details, and you have to go through those ones, and it is not easy to understand.
There's so much technical aspect
to
it.
Yes.
What the writer has pointed out on Huffington Post is only the tip of the iceberg.
Absolutely. But he has picked up major, very good points. Yes.
Very important. And I'm actually surprised that he's even put a number to that dollar amount, because a lot of times...
Absolutely. He went through all calculations.
Us as humans, we don't pay attention to words, but as soon as the numbers come, we tend to have special attention.
Absolutely. He it's an awesome kudos to him for this particular article there. Okay, let's get back to our format today, and this is where we are. So now, as ladies and gentlemen, we are now into the second phase at exactly half mark, and we'll try to wrap it up within the half an hour mark. And this is the rent to own, and we are going to explain you a few things that I mean it's not an easy one to put it rent to own from $2,500 per month, but we are I had to do a lot of research, and I'm going to walk you through those numbers, and let's see if something makes sense out here, and let's take it to the next level. Okay. So in order to get this particular one, I will be able to walk you through some of the back end work, and let's review that back end work. First is let's review the rental market report, where we are exactly these days. And this is the source is TREP Q4 2018 rental market report. As per this, a bachelor average rent is around $1,821 in quarter of 2018. The one bedroom is around $2,143. A two bedroom is around $2,774. And three bedrooms are beyond our reach these days, $3,366. So as you can see, it is in your interest to procure a property because you're already hitting these numbers and you're already in there. One bedroom, I mean, what will, like, it's hardly any space these days. Two bedroom, yes, you may be able to do something, but you're already crossing $2,800 approximately theirs. Okay, so having said that, given you a brief idea about what the rental market rates are, let's head to the next one. And I am at this moment trying to go through. Okay, I just pushed one extra button, so let me see if I can go back there. Okay, give me a moment here, and I need to get back to this one, and let's see if I can bring you back on this particular slide. Yes, here is the slide. Okay. I had gone through a few articles, and let me see. Okay, let me head back to the current slide that we had, and rental market report was done. This is, I just walked you through, and now let me take you over to this particular one, which is a condo apartment. Okay, I have to make sure I don't goof it up again. Okay, I had researched because I had to make a few basic assumptions, and then see if we can, if we are talking in the numbers of $2,500 per month or not, is that making sense or not? And the first assumption I had to make was, are there any properties up to $300,000? And yes, I could find a few, and that is what I have highlighted here. There are properties, and I've just picked up, there were some other properties below this particular price, but there are properties up to $300,000 as condo apartments. There are some one bedrooms and some of them are two bedrooms. So these are the numbers that are there any availability for condos in the price range of up to $300,000, and yes, there are. So that assumption which I had, in order to calculate all those particular numbers, I was able to walk you through here. Now let's go through the next assumption that I had, and that was regarding the maintenance. Okay, maintenance. Again, the same thing between 295 and 300, and the maintenance varied from 300 to almost to 600. And if you will see, some of them are even in the 500 range. So I took the halfway mark as assuming that the maintenance being equal to $500 per month. Okay. Now, the next assumption was the property taxes. Let me head over to our expert there. Anything amusing here?
I look at the slide, and a lot of our client at times they start to think many different things when they look at the rent to own and properties in the range that we have and such. But it does exist. We've seen clients doing those rent to owns. We've seen those clients go from rent to own to owning that property in 2 year, sometimes 1 year, sometimes 3 years mark, depending on how well they do as per the program. So yeah, all of those are actually possible real numbers.
See, the exercise I was trying to do here is finding you can own from $2,500 per month. It was an exercise for me. I just wanted to make sure before I explain to people that I mean whether something like this exists or not, and whether it is in their interest or not. And I found that it is in their interest, because 1 bedroom rental from 2,200 to 2 bedrooms from 2,800. I mean, why not pick up a property?
Yeah.
And for $2,500, because
Absolutely.
see, if the numbers were like you were getting 1 bedroom for $1,100 and 2 bedrooms in the $1,500-$1,600 range, and there is $1,000 difference, it was understandable. But now that difference has gone off the market. So when those differences have gone off, it is in everyone's interest to purchase it instead of renting it out.
Absolutely.
And that is why I wanted to, I went through these numbers, and I was making sure, like before I even explain these numbers to them, is there any property existing with those numbers or not? So that was the exercise. Let's see if I can make some headway further onto this particular one. Okay, so now we were on maintenance. That the maintenance, there were some 1 bedrooms. This is a bachelor at 323, but 1 bedrooms you could find from 448 to around 545, and I took a central number of around 500 here in order to explain this particular exercise for me. Let's head over to the third assumption that I did, and that was the property taxes. Now I took property taxes. If you can see, the same condos between 527 and 1565, and I took the mark around $1,200 or $100 per month basis. So that was the three assumptions I made, and on that basis I am going to now explain you this particular, that yes, it's a possibility. You can purchase a property for a rent to own format with around $2,500. Okay, so now let's head back over to the interesting aspect here. So I'm taking an example of a condo, and let's go through these assumptions which I just made with you. I took the price as $300, maintenance as $550 per month, and taxes at $100. I was thinking I took $500, but I have actually taken $550 per month. So these were my assumptions, and these are realistic assumptions, and on that basis I'm going to explain you, like, it is in your interest to procure the property rather than renting it out these days. Okay, now minimum requirements. Before I dwell into this particular one, there are some minimum requirements that you will be requiring. Your income has to be $75,000 per year, because in our various formats we have explained it to you, and when we are talking about the income, we are talking to you about the annual gross income. So if your annual gross income is close to $75,000 per year, 4 times the income, you will qualify for a property worth $300,000. Next aspect to it. Okay. Down payment. You will require a down payment of close to 5%, and that would be $15,000. Closing cost, we are generally taking a thumb rule. It should be around 1.5% of the purchase price, but I've just rounded the numbers to $5,000. Some miscellaneous, everything included there, and just rounding it the numbers to make it that the total you will require is close to $20,000. So these ones will be some of the basics that you will require. Without that, but obvious, the exercise cannot start. Now let's go through a buying option, and then the second one we are going to go through the rent to own options. Okay, the mortgage is going to be close to $1,450 per month. The maintenance that we have just discussed is close to $550, and the property taxes per month is $100. So the total amount comes to close to $2,100 per month. If you have a credit score of 600 and above and you meet these above minimum requirements, we will suggest you to go ahead with this particular option, because we should be able to procure a mortgage for you. And in our various webinars, we have already explained it to you. Rent to own is the worst case scenario, and it's a very, very costly program. So, but we have the options, and we are not negating those options, but we are trying to explain it to you. Ours is a smart rent to own program where we will go through the whole 9 yards, that if we have gone through all the options on the table, then we would suggest you that particular option, because before that we may have many other options for you. Now, interesting part in this particular one, if by chance, this we are telling it to you, your credit score is above 600, go for purchasing the property. If your credit score is above 680, banks may be willing to give you a 3% cashback. So that means now you had initially $20,000, but you may be able to get $9,000 back as cashback. The interest rate is slightly higher, but yes, you can procure this option, that so that you do not run very tight numbers and you have some other money in order to do some mild renovations or procure some other stuff for your new purchase. So those are the things that are also in the table. But remember, your credit score should be 680 and above. Okay, now let's get, if we have told you many a times, if the credit score is between 500 and 600, it is in your interest to go for a credit repair, because the credit repair may be faster than you paying more costly programs for the rent to own. And that is where, that's why I have not given you options between 500 and 600. If it is above 600, go for the purchasing. And if it is above between 5 and 600, go for credit repair, which will be faster. And we have our expert there. He has done wonders with the credit repair, and take his expertise there. You will be amazed at how fast he can get it repaired. Now, I may have to get out of this particular scenario, so to explain you this particular item I have. Credit score is below 500. Your mortgage remains similar. There is no difference there. The maintenance remains similar. The taxes, all those come into our calculations. Now, let's see, this is another amount that will come into picture, and that is an extra amount of money that will have to come into your down payment. The reason being, if you had come up with initially 5 or 7%, and yes, for rent to own, you will require 5 to 7% down payment. The reason here is the investor, our investors, they want to see some money of yours in the game. Some other rent to own programs may let you get away with 2 to 4%, but ours generally requires between 5 to 7%. So now, in order for your mortgage that you should be able to procure after 1 year, 2 years, or 3 years, you may have to take the entire amount from 5% to 10%. So making sure you do not lose your initial money and you are able to purchase the property, you will have to add some money towards your down payment. And that is where this amount may go all the way up to $2,500 per month. And that is where we are. And these numbers, that is what we are trying to explain it to you. It's a realistic possibility that a condo with a purchase price of 300 maintenance around the 550 marks, property taxes around 100, you should be able to procure in for a rent to own program from $2,500 per month. There are another assumptions that you'll have to, let me see. There is also one component more, and that is that the property appreciates by 4 to 5% per year. So you will have to take that also into account whenever you are trying to do a rent to own program. Let me head back to our expert there and seek his information on what I have just explained.
Now, keeping in mind that we are at 7:51, I'm going to cut short and summarize very quickly. If you can give me that slide again, I'll go line by line. There's a couple of things that I've seen that I want to point out.
Give me 1 second and I'll give you the slide.
Perfect. So the first one that I see is a standard system. It's a purchase, 75,000 income, down payment, closing cost, and so on. Now the second part where everything else is in line that I'm seeing, buying with 3% cashback, and I'm just adding to your sentence that the interest rate may be a little bit higher. Now I'll elaborate more on it. When the bank is giving 3% cashback, they're expecting that cashback paid over the 5-year term.
Yes.
Therefore, that cashback has to be paid back, and that's how the interest is adjusted. The client is not paying extra, they're just paying over time. Instead of having full 5% down payment, they have 3% cashback. So technically, they only have 2% down payment, and the 3% that was cashback is paid over time. So just to give a little additional.
Absolutely. Those are the details. Yes. When you the interest rate is slightly higher, and the main thing here is in case if you break the mortgage, then you have to pay this cashback back. But I mean, once you sit down and work out the numbers for the cash, see, the main thing here is, and this we have seen with numerous of our clients, that don't run very tight ship.
No.
You need some money sometimes. There are see, if you're running on a very tight numbers and suddenly then an extra expense comes, you'll be stranded. And that is where this money comes in handy.
I have a very interesting line for that. It's called house rich, cash poor.
Absolutely. Very well said. Okay. Now, I am going to take over with this particular same format, but in case if it's a house, and can I find a property, not a condo, a house, and work with these same numbers? So let me take my next 7 minutes to explain that format.
Can I intercept
Sure.
for a second? The last part, rent to own, you did mention that our down payment may be 5 to 7%, and there are comparables others that may be 2 or 4%. What I do want to point out is the contracts make or break it. There are lots of contracts that are a lot more complex versus what we have in place. So those.
The reason I was wanting to explain that particular thing here is see, when prospects call us, we have to. This is our format. Because this is not a standard contract kind of a format, and there are many other people in the market. If you have less down payment, you may have other options on the table there. So I'm just trying to give them a whole 9 yards that our format is we have investors who would like to see some more money from you. Then they are that is how they are. And even condos, all of our investors are not comfortable with condos. They would prefer houses because they appreciate more in value. So those are some of the stuffs that we have with our investors, and that is why when someone is listening to us, they have to understand different rent to own programs have different formats. So it is not like everyone has a standard format and everyone is following it. So it is, in case if they are finding us limited, then they have other options and they can easily search online. There are numerous companies who are doing rent to own, and they should be comfortable there. Okay, before I am able to, I think so we are going to go overboard this time, and we might have to finish this up, because this is one part that we need to get within one webinar of ours. Okay, so detached house. Now again, because in a condo we only can get you 4 times the income, whereas in a detached house, because of the less maintenance fees, we might be able to push it further. And that is why we did some numbers crunching, and all the way up to 340 we may be able to go. So that is why I then procured some of the properties that are detached properties and trying to figure it out if they are between 300 and 350, and I could find a few of them ranging from 2 bedrooms, 3 bedrooms, and we are talking in the GTA, not only in Toronto. So don't get confused there. We are talking about in the outskirts. There is hardly anything as a detached property in the Toronto area. So we are talking more on the GTA format about detached properties here. And there are few properties between 320 and 350, and I procured a few of them to show you as an example, and I am now going to work on the number of 340 for our example there. Okay, again, there was another assumption I had to make, and that was the property taxes. So the property taxes were all the way from 1,300 to 3,000, and you will see somewhere in between you have like 6-7 of them up to the $2,400 mark. So that is one of the exemption I take as $200 per month, and for a year it's going to be 2,400. And those were the 2 exemptions, and on that basis I have this example for you now. Okay, now again we are now seeing the same example for a detached property. Price range $340,000. Utilities, I'm taking a round number again, and at $300 per month, and taxes being $200 per month. Okay, so now let's see again. Income requirement 375 will still work, because we can get you 4.5 times the income, and that is why you can go all the way up to 340 if it's a house. House, semi-detached, town, freehold townhouse, all of them will formulate in this particular one. Down payment, you will now require $17,000 as 5% of the purchase price, and the closing cost is still within the $5,000 mark, because in the last one we took more. In this one you should be fine, and so your total down payment will be close to $22,000. Again, credit score, if the credit score is above 600, you should be able to purchase this particular property, and we can assist you in that particular one. Mortgages should be close to 1,600, your maintenance close to 300, your taxes close to 200, and again your per month may be closer to $2,100 there. So we are taking maybe a variable rate on this particular one if it's possible, because bringing it down to all the way to the $1,600 mark, that may be an exercise in itself. Again, cashback with its limitation and higher slight interest rate, and again with 680 credit score you can procure a 3% cashback as $10,200 from the banks. Again, if your credit score is between 500 and 600, we strongly advise you to go for a credit repair and get this one. Again, rent to own option is a very costly program, and we would like you to take that as the last resort. Now again, let me get out of the frame for a moment to explain you this particular equation, and then we take it from there. Okay, let's see. I hope I'm out of the frame. Again, the mortgage is around $1,600. The maintenance is around $300. Same thing, taxes remain the same. And this is the added one that comes into the picture. And that is what you have to comprehend, that in a rent to own, you have to have an additional down payment. And the total per month, again, we were able to bring you down to $2,500 per month. And there is a property appreciation fees for around close to 5% per year. So with this, I will try to wrap this up within the 1 hour mark, exactly to be precise there. And I will take this opportunity to say a big thank you to our expert there, so that we are on time and close it in the right time frame.
Thank you for having me, and thank you for the audience. Thank you.
Really
to the
appreciate,
audience.
and thank you to all the audience. We are trying to wrap it up within our 1 hour mark, and we will see you next week. Though it's a family day, we'll still try to be there, and between 7 and 8 p.m. and look forward to meeting you next Monday. That would be, I would say, 18th of February, and we'll see you all there. Thank you, everyone.
Have a good week.
Thank you, audience. Thank you, Faisal, and greatly appreciate all your time and efforts here.
Thank you, sir.
Thank you, sir.